Hello, friends. Welcome to this live Fed rate decision coverage. To start with, the US Central Bank is expected to keep rates unchanged and signal patience on hiking rates further. Most investment bank forecasts that I've seen talk about the dot plot possibly revising the 2019 rate forecast lower to one rate hike from the December forecast of two rate hikes. And there's quite a consensus out there that even Fed would signal one rate hike for 2020. Now, the funny thing is that market is already has already begun pricing a rate cut in 2020, and over the last few years, we have observed that Fed just follows what markets uh, you know. Fed just delivers what market expects. So even if there's a feeling that even if Fed retains the uh, rate hike bias, eventually it would down the line, maybe a couple of months down the line, it would again uh, deliver what markets want. For now, at least, I would say the bar of dovish expectations has been set higher. Markets have priced in uh, what Fed is expected to do today. For instance, if I would just talk about euro dollar. For instance, euro dollar had dropped below 1.12 few days back, confirming range breakdown, and that was really a serious technical breakdown. But it ended up trapping the sellers on the wrong side of the market. It's back above 1.13, now trading at 1.1351, and the spread between the euro I'm sorry, the spread between the US 2-year and German 2-year bond yields has dropped below 300 basis points, I suppose, and that's like 11-month low. So I feel the dovish outcome has been priced in. So if Fed meets market or fails to beat market expectations, I expect the dollar to pick up a strong bid. I see dollar falling if the dot plot says no rate hikes for 2019 and leaves the door open for, let's say, 2020 rate cut. I personally feel that if the dot plot shows no rate hike for 2019, it's as good as signaling a rate cut for 2020. That would be a dovish development, something that would surprise markets, I feel, and could lead to dollar weakness. But one rate hike for 2019, it's no surprise, and dollar would rally in that case. Also about quantitative tightening, if they refrain from detailing the plan on how they are going to end balance sheet normalization process, then that too would be considered as hawkish development by markets. And again, the greenback would, pick up a bid. See here, euro dollar, a quick recovery from the lows seen on the lows near 1.1176 seen on March 7th. Let's take a look at some other forex pairs. Dollar yen 111.47, having clocked a high of 111.69. Pound dollar is falling. This one has been a complete mess. If you are a trader, if you're a pound trader, you know what I'm talking about. This Brexit saga has just made it really it has become impossible to trade this pair. Let's take a look at Aussie dollar 7095. It's funny that the risk reversals on Aussie dollar and New Zealand dollar are at 3-month highs. I say funny because on one hand, markets are speculating that their respective central banks are heading towards rate cut, and on the other hand, the options market is unwinding bearish bets. So it's something else, some contradictory signals from related markets. Like rates markets are pricing in easing, and on the other hand, options market, they are unwinding bearish bets on Aussie dollar. So let's see how it goes from here. USD CAD, this long-tailed candle that I see here, that's what makes me a bit bullish on this one. However, as a trader, if I want to trade this one, I would at least wait for a convincing break above 1.3347. That would be a good development on charts. NZD, interesting chart again. We have it's been squeezed right now, getting squeezed between lower highs and higher lows, like forming a contracting triangle on the chart, and the decisive breakout is awaited. Gold, I see kind of bear flag on this one. It's developing, and let's say if it breaks below somewhere around 1298, if it find acceptance below that level, I think we are heading back to 1280s and possibly may break lower to even 1260s. The fact that the yellow metal has created a bearish pattern ahead of the Fed, a bearish pattern like bear flag ahead of the Fed, makes me tells me that maybe, just maybe, Fed is going to sound less hawkish, less dovish, or might just sound hawkish. Let's just wait. Uh, but looking at gold chart, that's what I feel. Remember that gold was trading at 1160. No, I'm sorry. Gold had dropped to 1160 in August, and all of a sudden it picked up a strong bid in November and zoomed to 1300 in 2 or 3 months. So it's like Fed's dovish shift has been largely priced in. Like there's nothing new if Fed says that they're going to hike rates at a slower pace. I think the only way dollar could take beating, a real beating, is if the dot plot hints at a rate cut, or they really they detail how they are going to end their quantitative tightening program. Also, it might be creating a head and shoulders pattern. You might have read about these reports on FX Street, with neckline somewhere around maybe 1283, 1284. We are getting closer now to the event. Hang on, guys. I'll be back in a few minutes. It's just dull out there right now. Okay, back here, pretty much the same market. Fed decision is just 3 minutes away. It's 1 minute to go, and the action begins. Action is about to pick up. I hope so. Let's see. Morgan Stanley is saying that the main driver of action will be the dot plot. It is the interest rate forecast. I agree. Market expects the Fed to stay dovish as growth predicted to slow in 2019. Officials seen cutting high frequency. All this is priced in, as I said a few minutes back. Just look at the gold chart. It has rallied from 1200 to 1300 in just 3 months. All the dovishness that markets are talking about or the investment banks are talking about is already priced in. It's out. Federal Reserve leaves interest rates unchanged as expected. And gold has just recovered from session lows, now trading at 305, was trading at around 302 soon before press time. I would like to see, let's see what's happening in the 10-year treasury yield. And now 306 on gold, and I see euro dollar at 1390. So maybe, just maybe, something more dovish has come out, or we'll just avoid trading right now. Let the market settle in. Let AUD above 0.71. Dollar yen hasn't moved much, still 1.25. So things are getting interesting. Dollar yen is falling now. It's at 111.21. Having clocked a high of 111.50. So yes, as I said, the bar of expectations, was way too. The bar of dovish expectations was way too high for the Fed to beat, and I just think maybe just Fed has delivered something really dovish because the dollar is getting whacked across the board. See a 50 drop in USD yen, and around 30-40 pip jump in that's euro dollar for you. It's at 1.1389. Details are flowing, hitting the wires. That's it. FOMC dot plot shows no hike in 2019. GDP cut to 2.1% versus 2.3%. So if you remember what I said in the run up to the Fed, if the dot plot shows no hikes in 2019, it is as good as a rate cut in 2020 because Fed can always go always revise the dot plot to show a rate cut in the next few months. So yes, that's the reason why the dollar is getting is taking a beating here. Now the euro dollar is at 1.14, and I think it could go a heck a lot higher from here. Fed also intends to slow balance sheet runoff starting in May and ending in September, provided economy evolves as expected. Says growth has slowed. So this is a dovish Fed policy that will likely bring cheer in Trump's life. Pound dollar above 1.32. Labor market remains strong. Average job gains solid. Indicators pointing to slowing growth in household consumption. Inflation has declined largely due to energy. So this can pick up going forward because oil prices are rising. Market-based inflation measures remain low. Difficult to trust them. Survey-based inflation little change. Futures reporting 0.16% gains. S&P 500 futures, Nasdaq up 0.59%, S&P 500 index flat. Meanwhile, Dow Jones is still reporting 11-point drop. Euro continues to climb 1.1414 now. Dollar sell-off is still somewhat surprising for me. The reason being, no, Fed hasn't really done anything. This whole thing that the dot plot now says no rate hike for 2019. It's coming as a surprise because most investment banks were expecting it to expecting the Fed to signal at least one rate hike this year. Ignoring this the investment bank forecast over the last few days. If you ignore this forecast, markets already knew that Fed would pause rate hike. This rate pause thing has been in the air since late November or early December, if you ask me. So, sell-off, dollar sell-off that we are seeing right now, I would like to see if this is extended further, because this is not news for markets. It's only looking dovish because most investment banks were calling at least one rate hike for 2019. Markets have been speculating about a rate pause and possibly have priced in a rate pause since November. That's the reason why gold just zoomed on November 12 or 13. It was trading around $1,200, and a matter of few weeks, it zoomed to jumped above $1,300. So this is not news. I don't think this is news for market. As of now, I see gold trading at $13.10, which down. It is already given up a few points. It clocked a high of 13.13. Yeah, and now it's down to 1310. Let's see, keep a watch on gold. If it continues to pull back, then that could be considered an advanced indicator of dollar potential recovery in the potential broad-based recovery in the US dollar. Euro is now trading at 1.14, 1.139, 1399, having clocked a high of 1.1415, I guess, a few minutes before press time. So it's getting interesting, obviously. The euro dollar, I think, is the case for euro dollar looks bullish. What I mean to say is, even if the dollar recovers the lost ground, I think euro would still outperform other majors for two reasons. If US and China reach a trade deal and US removes tariffs on China and everything, all the trade tensions ease, it's going to bode well for Germany, and that would embolden ECB to prepone the rate hike, which recently they have pushed out to 2020 as expected or anticipated by markets. So an early rate hike would be positive for Europe. At the same time, you have Fed who has simply given what markets have already priced in. So euro, even if there is a broad-based dollar recovery, euro would outperform other measures. So it's a good trading opportunity in pairs like AUD, Euro NZD, maybe to some extent uh, Euro INR or emerging market currencies. This candle looks really, really bullish, and if it closes this way, it would be a bullish hammer. Don't forget that weekly chart is full of sorry, this is the monthly chart. A weekly chart is full of long tail candles. Even the monthly chart, if you see, bears have seldom managed to keep the pair at lows till month end. There has always been a dip demand or seller exhaustion, and that is something somewhat a cause for concern for people who are sellers of Europe. This chart looks really bullish. Any dip, let's see. Let's see from here on in, especially if Trump, especially if US and China agree on a trade deal and trade tension cease, I would look out for opportunities to buy euro against currencies like Aussie dollar, especially because the RBI is moving towards rate cut. 10-year yield 2.55%, and looks set to close below 2.54, which would only accentuate, only bolster the already bearish technical setup. The curve between 10s and 2s is flatlined around 15 basis points. So fears of curve inversion might ease somewhat now, with Fed turning dovish. US the spread between US 10-year and German 10-year has dived since. It had confirmed a rising wedge breakdown on Feb 26, but follow through wasn't really bearish. Spread rose back to around 2.57, and by March 8, March 11, I suppose, yeah, and now it's now falling. So the focus is back on the rising wedge breakdown. So I think the low seen early January, that is 239 basis points, could soon come into play. And that's good news for Euro. Dollar rupee is falling. Dollar rupee CFD is at 68.48 now. I think this is good opportunity for RBI to come in strong, because there is strong upward pressure on rupee, or the downward pressure on dollar, and during such environment, anti-dollar environment, I would say, or bearish dollar environment, it's an opportunity for the RBI to step in and especially infuse liquidity ahead of elections. So let's see whether RBI does step in tomorrow and defend 68. Gold 1313. It's not pulling back. So as long as gold isn't showing any signs of stress, it's time to be short US dollars. Once I see gold feeling the pull of gravity, I think I would want to move out of dollar long positions. No, I'm sorry, dollar short positions. Every USD going up nice now, around 0.71, 0.7136. This one could really fly high, to go something like 0.72 or higher. If the jobs report due in, I think, 5 or 6 hours from now, if the jobs report, Aussie jobs report, blows past expectations, it will likely ease concerns and force markets to go slow on pricing RBA easing. Put simply, it would bode really well for Aussie dollar. It's already on the offensive. Looking at the chart here, it's really looking good right now, with RSI pointing north, position above 50, and my MA studies are looking really good. Our MA studies are curling upwards. Price has broken through key trend line resistance. So it's all happening for Aussie dollar. All we need now is a stellar jobs report, and off it would go to around 72, 90 or 73. USD is really falling now. It's below 111. I think this is it. This, this is it. I think 112 is the top in USD JPY, and the pair is heading back to, I suppose, 108 in the near term. And who knows, even a deeper drop. On the daily chart, I see a minor head and shoulders on price and a very well-defined head and shoulders on the 40-day RSI. RSI has also breached the ascending trend line and has just dropped below 50, confirming the bearish trend change. So, go short on USD JPY for a target of 108 with stops below 112, above 112. Looks good trade. Dollar really getting whacked here. Oh boy, it's a big red candle. To conclude, I think Fed's decision to signal no rate hike in 2019, it's coming off as a dovish surprise, or market is treating it as a dovish surprise. In my opinion, is only because almost all investment banks were still expecting the central bank to signal at least one rate hike. Although from November, December, the rate pause talk has been doing the rounds, and markets have already priced in. So, I'm a dollar bear here, but I'm still cautious. Cautious because, as I said, that Fed would pause rate hikes in 2019 has that talk has been in the air for more than almost 4 months now. So this is not really a dovish surprise, if you ask me. That being said, the fact that Fed has given markets what they wanted may reinforce expectations that it would eventually, it has, or I would say has likely reinforced expectations that it would eventually go on to cut rates in 2020, and that might be the reason why the dollar could be the reason for an extended drop in the US dollar. As a trader, I would just look at where the 10-day moving average is, and if the price is trading, if the pair is trading below the 10-day moving averages, I would want to enter short trades on minor bounce. That's the only way you can. That's the easiest way of trading this wave of dollar selling wave that we are seeing right now in markets. So that's it for today. I hope you enjoyed, and shall see you next time. Thank you.